Hello, everyone. A huge, warm welcome to you all. Thank you so much for clicking on this video and spending part of your day with us. We really appreciate you being here. We have a packed session lined up covering some massive movements in the financial world.
No, it's great to be here, and we really are looking at a giant today. We're breaking down the Charles Schwab 2026 Winter Business Update. This call took place on January 21st, 2026, and it featured a very detailed presentation from their CEO, Rick Worcester, and CFO, Mike Berdeschi.
Right. And before we get into the heavy financial data, and trust me, there is a lot of it, I have to talk about the vibe of the call. Usually that housekeeping part of these updates is where everyone tunes out. But Jeff Edwards, the head of investor relations, actually started things off with some personality.
He really did. It set a surprisingly loose tone. He specifically warned the analysts against asking what he called nested babushka doll questions.
I loved that visual.
It's perfect, right? We've all been on those calls where someone says, I have one question, and then they proceed to ask 5 different things all wrapped inside one sentence.
Exactly.
Edwards shut that down right at the start. He also called their forward-looking statements slide, the legal disclaimer, the wall of words, which was, I thought, a refreshing bit of self-awareness.
It signals confidence, doesn't it? If you can joke about the legal stuff, you probably aren't worried about the numbers you're about to show. And looking at the 2025 performance, they definitely had reasons to be confident. They're calling it a record year.
And the data backs that claim up completely. Let's look at the biggest metric for a firm like Schwab, core net new assets. This is essentially the fresh cash coming in. In 2025, they brought in $519 billion.
$500 billion in net new assets.
Exactly. And to put that in perspective, that is up 42% compared to what they brought in during 2024. The momentum is it's accelerating.
And where is this coming from? Is it just, old money getting older, or are they finding new people?
That is the most interesting part of the update. They opened 4.7 million new brokerage accounts, which is a 13% increase. But the demographic mix is shifting. Nearly 1/3 of those new accounts are from Gen Z.
That sort of contradicts the usual narrative that Gen Z is only on, Robinhood or Coinbase. It sounds like they are actually moving to the legacy players.
They are. Schwab has successfully lowered the average age of their client base. And for a financial institution, that is the holy grail.
Right.
I mean, if you catch a client in their 20s, you potentially have 50 years of fees and relationship building ahead of you.
Speaking of fees, let's look at the bottom line. Record net revenues of $23.9 billion. But the number that jumped out at me was the earnings growth.
It was massive. They posted record-adjusted earnings of $4.87 per share. That is a 50% jump year over year.
50%. For a company of this maturity, that's just wild. How did they pull that off?
It really comes down to scale and efficiency. They emphasized just how big the machine has become. I mean, they handled 30 million service calls last year.
30 million.
And the average answer time was under 30 seconds. Plus, they processed 1.9 billion trades. When you operated that volume, even, small efficiency gains translate into massive profit jumps.
It sounds like the engine is running perfectly. But they didn't just pat themselves on the back for 2025. They laid out a new strategy. They talked about moving from just being a broker to something bigger.
Right. They identified 2 growth levers.
Yeah.
One is obviously serving more clients, but the second one is deepening relationships. They want to be the entire financial ecosystem for their clients. They don't just want to execute your trade. They want to handle your lending, your estate planning, and your private investments.
And they made some acquisitions to back that up, didn't they?
They did. They highlighted the acquisition of a company called Forge. This is all about democratizing private investing. Historically, if you wanted to invest in private companies before they go public, it was very hard to do in a standard brokerage. By buying Forge, Schwab is bringing that capability in-house.
They also mentioned investments in Capita and Wealth.com.
Yep. Capita handles equity management for private companies, and Wealth.com is for estate analysis. So if you look at the puzzle pieces, private equity, equity management, estate planning, they are building a fortress around the wealthy client.
So you never have a reason to leave.
Exactly. They want to make it so you never have a reason to leave the Schwab ecosystem.
That leads us to the guidance. They gave us the roadmap for 2026. But every roadmap relies on the weather, or in this case, the macro economy. What are they assuming happens this year?
This is where we need to look closely at the fine print. Their 2026 scenario, it assumes the Federal Reserve cuts rates by 225 basis points. They're modeling the target rate dropping all the way to 3.25%.
Wow, that is a pretty aggressive cut compared to where we've been.
It is. And they're also assuming a 6.5% return in the equity markets. So based on those assumptions, rates down, stocks up, they're projecting total revenue growth of around 10%.
And for the shareholders watching, what does that translate to for earnings per share?
They are guiding for adjusted earnings between $5.70 and $5.80. That would be upper teens growth on top of the record year they just had.
So robust growth is the headline. Now, I want to transition us into the Q&A session. This is my favorite part because, the prepared remarks are the script.
Right.
But the Q&A is where we find out what the analysts are actually worried about.
Absolutely. And the analysts were definitely digging for details this time.
Okay, let's kick it off with the first question. This came from Devin Ryan at Citizens Bank. He was looking at the balance sheet. Basically, now that Schwab has paid down their supplemental funding, he wanted to know about the remixing, specifically about the securities portfolio size, timing, and duration.
This is a technical question, but it's crucial. He's asking, so what are you doing with all the cash? Mike Berdeschi, the CFO, he took this one. He was very clear that the primary focus is on lending growth, so things like bank loans and margin loans. But for the investment portfolio, he said they plan to reinvest proceeds primarily into short-dated U.S. Treasuries.
Short-dated, so they aren't locking money away for 10 years or something.
Exactly. They are keeping the duration target between 2 to 4 years. The goal here is liquidity. They want to make sure that if clients need cash, it's there.
So safety first.
It's a conservative approach.
Yeah.
They are prioritizing safety and liquidity over chasing higher yields in long-term bonds.
Okay, moving on. We had Ken Worthington from JP Morgan. He asked about that alternatives platform we mentioned earlier. He wanted an update on engagement and asked a pretty direct question. Is the pricing actually disruptive enough to attract new assets?
And CEO Rick Woodchester jumped in here. He noted that there is actually a backlog of clients waiting to speak with their alts consultants.
A backlog is a good problem to have.
It is. And Rick made it clear that their goal is to be the premier destination for ultra-high net worth clients. By offering leading managers, passive funds, and that direct access through Forge, they believe this will drive net new asset growth. They're basically telling the wealthy, you don't need a boutique firm, we can do it all, and probably cheaper.
Next up was Brennan Hawken from BMO Capital Markets. He wanted some color on the growth trends between the two main sides of the business. Advisor services versus investor services, which is the retail side.
This was a great breakdown. Berdeschi explained that growth is accelerating everywhere. Retail grew about 33%, but advisor services grew over 42%.
And on the retail side, this is where that social media strategy came up, right?
It is. They explicitly mentioned that Gen Z is crucial and that Schwab is massive on TikTok and Instagram. They're meeting younger investors where they are. But they also mentioned future accelerants, like launching spot crypto trading.
Spot crypto is a big move for a firm that's seen as pretty conservative.
It is, but they know they needed to compete. They also mentioned expanding the workplace business. And on the advisor side, the argument was simple. Schwab's scale and custody offering are just too hard for competitors to match.
So if you're an independent advisor, they're the default choice.
Pretty much, yeah.
That scale is a recurring theme. The next question came from Dan Fannon at Jefferies. He focused on lending. He asked what constitutes a reasonable level of penetration for existing clients. Essentially, how much more money can you lend to the people who are already banking with you?
And the answer from the CEO was tremendous upside. He shared a statistic that was quite shocking. The current penetration of pledged asset lines among high net worth retail clients is only 9%.
Can we just pause there? What exactly is a pledged asset line?
Sure. It's basically borrowing against your portfolio. So let's say you have $2 million in stock and you want to buy a vacation home. Instead of selling the stock and paying taxes, you take a loan using the stock as collateral.
Ah, okay. A classic tool for the wealthy.
Right. And only 9% of Schwab's wealthy clients are doing this. In their advisor services business, it's 23%. So the CEO looks at that gap and sees billions of dollars in potential loans just sitting there.
They don't even need new clients to grow it.
Nope. They just need to sell the product to the clients they already have.
Okay, let's talk capital returns. Alex Boston from Goldman Sachs asked the question every shareholder loves. What about buybacks? Specifically, are buybacks baked into that 570 to 580 earnings scenario?
The short answer from the CFO was no. The earnings scenario they presented does not include buybacks.
That's interesting. So the growth guidance is purely operational.
Correct. Their priority is supporting franchise growth. However, Bradeschi reaffirmed their capital framework. They aim for a 20 to 30% dividend payout ratio. He clarified that buybacks remain a tool, to return excess capital opportunistically, but they aren't relying on shrinking the share count to hit those targets. It's organic.
That's a sign of confidence. Next, we had Stephen Churich from Wolfe Research. He asked about tax-advantaged long-short strategies. He noted they have lower spreads, so he was wondering how deep the penetration can get and how the return on assets compares to loans.
Management views this as a win-win. Yes, the spreads might be a bit tighter than a standard loan, but it's fee-based revenue. That means it doesn't bloat the balance sheet with risk.
And it sounds like it creates a really sticky relationship.
Absolutely. It helps high-net-worth clients manage concentration risk and taxes. These are complex needs. When you solve a complex need for a wealthy client, you deepen the relationship. And Schwab noted that these clients have the highest promoter scores, so even if the margin is slightly different, the lifetime value of that relationship is massive.
Now, this next question was probably the highlight of the call for me because of how firm the answer was. Brian Bedell from Deutsche Bank asked about prediction markets. He asked if Schwab would launch contracts for fundamental investing or economic indicators. Not sports, but financial stuff.
This was a fascinating distinction. Regarding financial prediction markets, like hedging against inflation numbers or employment data, Schwab said they are open to it if it helps clients manage portfolios. But they noted that active traders aren't really asking for it yet. They just want better mobile apps and research.
But then the conversation pivoted to the other side of prediction markets, sports betting.
And this is a hard no. CEO Rick Worcester did not mince words. He emphasized that sports gambling, platforms like DraftKings or FanDuel, it contradicts Schwab's mission.
What was the logic there?
He said Schwab is about wealth creation. And he cited data saying that less than 5% of sports bettors leave with more money.
I loved that. He basically said, we are here to help you get rich, and gambling makes you poor. It's a very clear line in the sand.
It is. It signals that they aren't just chasing every revenue trend. They're protecting the brand's integrity. They want to be the serious partner for your money, not the casino.
Moving on, Bill Katz from TD Cowen asked about the growth guide. He pointed out that the organic growth guide is only 5% for 2026. That's actually a deceleration from the 5.1% they did in 2025. He also asked about the leverage ratio ramping up if they aren't doing aggressive buybacks.
The CEO handled the growth question by emphasizing the denominator. 5% growth is the near-term target, but that is on a much, much larger asset base. Remember, assets grew 18% last year.
So 5% of a much bigger number is still huge.
Exactly. It's still a massive amount of inflows. And long-term, he still sees potential for 5 to 7% as their crypto and workplace strategies mature. On the leverage ratio, the CFO just stated the objective remains 6.75 to 7%. They're going to manage the capital stack to stay in that sweet spot.
We also got an update on a topic that's been hovering over Schwab for a few years now, the Ameritrade integration. Benjamin Budish from Barclays asked about the legacy Ameritrade customer base. How are they behaving?
The news here was very positive. The CFO stated that Ameritrade client behavior has, quote, normalized. It's right where they want it. Net new assets from that group have turned meaningfully positive.
That's a big turnaround from the integration phase a few years back when there were some headaches.
It is. And they're engaging heavily. 30 to 40% of flows into wealth and lending solutions are coming from that group. The message was clear. The integration pain is effectively over.
Finally, we had Mike Brown from UBS. He asked about margins, specifically if there's a ceiling, given they are expecting the low 50s in 2026. He also asked for specific KPIs regarding AI revenue lift versus efficiency.
On margins, the CEO said there's no arbitrary ceiling. Margin expansion comes from revenue diversification plus expense discipline. But the AI answer was really telling.
Right. Everyone talks about AI, but are they actually using it to save money?
Yes. They said AI is already driving efficiency. They are growing accounts and assets without needing to proportionally grow client-facing headcount. The metric to watch here is EOCA expense on client assets. That number continues to decrease. Basically, AI is allowing them to get bigger without getting bloated.
That is the dream for any large enterprise. Okay, we have covered a lot of ground. Let's zoom out. If you had to, synthesize the main themes from this, what are the big takeaways?
I think there are four main pillars here. First is diversification. Schwab isn't just a trading shop anymore. They are aggressively moving into wealth management, banking, lending, and alternative.
A one-stop shop.
One-stop shop for the wealthy, yeah.
Yeah.
The second is future-proofing.
And what do you mean by that?
The focus on Gen Z, the digital experience, integrating AI.
Yeah.
They aren't resting on their laurels. They are building for the next generation of investors with things like spot crypto and their TikTok engagement.
And financially.
That's the third theme, financial strength. They've moved past the cash sorting issues of previous years. They've paid down expensive debt, and they're projecting strong earnings growth around 18% for 2026.
And the fourth theme?
Integrity. That refusal to enter sports betting. It highlights a commitment to long-term wealth creation over quick-buck trends. It tells you exactly who they are and who they're serving.
That is a fantastic summary. It sounds like Schwab is positioning itself to be the adult in the room, reliable, diversified, and growing.
Absolutely. They are playing the long game.
Well, that brings us to the end of our breakdown of the Charles Schwab 2026 Winter Business Update. Thank you all so much for watching the video. We hope this helped you cut through some of the noise.
Thanks for watching.
If you found this update helpful, please do click the like button, share the video with your network, and subscribe to the channel. We have a lot more content coming your way, so stay tuned.